How does a gangster worth millions legally report just $495 in annual income? You exist in a financial landscape where the ultra-wealthy treat tax codes like a choose-your-own-adventure novel, while the IRS hunts down average citizens for minor errors. The system doesn't fail the powerful, it serves them. When Grammy winners go to prison while corporations hiding billions receive slaps on wrists, the double standard becomes painfully clear. In this video, we're uncovering 51 staggering cases revealing how celebrities, politicians, and corporate titans engineered elaborate schemes to dodge their civic obligations. Because the biggest heist in history isn't robbing banks, it's avoiding paying into them. 1. Al Capone's downfall wasn't from his bootlegging empire or numerous murders, but from something far more mundane: taxes. In 1931, the Chicago gangster who terrorized the Windy City finally met his match in a group of accountants. After years of eluding murder charges, Capone couldn't escape the IRS, who meticulously documented his lavish lifestyle that didn't match his non-existent tax returns. While he publicly flaunted his wealth with custom suits and diamond jewelry, he claimed to have no taxable income. The court disagreed. Sentenced to 11 years in federal prison, including time at Alcatraz, and fined $80,000, equivalent to over $1.5 million today, Capone's case became the blueprint for prosecuting organized crime figures. His conviction cemented the adage that has haunted criminals ever since: you can escape the police, but you can't escape the taxman. 2. Walter Anderson orchestrated the largest individual tax evasion scheme in American history until 2020, hiding over $365 million of income through an elaborate web of shell companies spanning from Panama to the British Virgin Islands. As a telecommunications entrepreneur during the 1990s telecom boom, Anderson made hundreds of millions but reported earning just $67,939 in 1998, paying a mere $495 in taxes when he should have paid millions. His downfall began when investigators noticed his extravagant spending: private jets, million-dollar homes, and rare art collections, which didn't match his reported income. When authorities finally caught up with him, they found detailed notebooks documenting his offshore accounts under aliases like Mark Roth and William Prospero. In 2006, Anderson pleaded guilty to hiding more than $200 million in taxable income, resulting in a 9-year federal prison sentence. His case prompted significant reforms in how the IRS tracks international financial transfers and offshore holdings. 3. Houston billionaire Robert Brockman created what prosecutors called the largest tax fraud ever perpetrated against the United States, concealing approximately $2 billion from the IRS over 2 decades. The tech mogul, who built his fortune through auto dealership software, deployed an arsenal of tax evasion techniques worthy of a spy novel. He used encrypted communications, code names like Permit, Redfish, and Snapper, and maintained a complex network of offshore trusts in Bermuda and Nevis. The scheme began unraveling when a business associate turned government witness provided authorities with encrypted messages and meeting recordings. Indicted on 39 counts, including tax evasion, wire fraud, money laundering, and evidence destruction, Brockman's case represented the pinnacle of sophisticated financial crimes targeting the U.S. Treasury. The investigation required unprecedented international cooperation, marking a significant shift in how aggressively the government pursues ultra-wealthy tax evaders. 4. Vice President Spiro Agnew's spectacular fall from grace began with an investigation into contractor kickbacks and ended with his resignation on October 10, 1973. Though initially under scrutiny for bribery while governor of Maryland, federal prosecutors ultimately nailed him for a simpler crime: tax evasion. Agnew had failed to report $2,900 in kickback income on his tax returns. The investigation revealed a pattern of corruption stretching back to his days as Baltimore County executive, where contractors seeking government work would deliver cash payments, often in plain envelopes, directly to Agnew's office. Facing mounting evidence, he negotiated a plea deal, becoming only the second vice president in American history to resign, and the first to do so because of criminal charges. His departure during the Watergate scandal period nearly triggered a constitutional crisis, as both the president and vice president faced potential removal from office simultaneously. 5. When hotel magnate Leona Helmsley allegedly uttered the infamous words, "Only the little people pay taxes," she inadvertently wrote her own criminal indictment. The self-proclaimed Queen of Mean built a real estate empire alongside her husband Harry, amassing luxury properties, including the Helmsley Palace Hotel. Behind the glamorous facade, Helmsley was systematically charging personal expenses to her business entities, including a $1 million marble dance floor for her Connecticut mansion and $58,000 in designer clothes. After disgruntled employees tipped off authorities, prosecutors led by future New York City Mayor Rudy Giuliani built a case showing Helmsley had evaded $1.2 million in taxes. Her 1989 trial became a media spectacle, with former employees testifying about her tyrannical management style and tax fraud schemes. Convicted on 33 counts, she served 18 months in federal prison and paid $7.1 million in fines and restitution. Her case remains a cautionary tale about the consequences of flaunting tax evasion. 6. Wesley Snipes' tax troubles began when he embraced the 8 nor 61 argument, a thoroughly debunked tax protest theory claiming that U.S. citizens don't legally have to pay income taxes. The action star, who ironically portrayed a law enforcement agent in the Blade trilogy, stopped filing returns from 1999 to 2001 while earning roughly $40 million from his film career. Snipes aligned himself with anti-tax advisors who promoted sovereign citizen ideologies, even submitting a 600-page document to the IRS demanding refunds of all taxes he had previously paid. The strategy backfired spectacularly. In 2008, a Florida jury convicted him of 3 misdemeanor counts of willfully failing to file tax returns. After exhausting his appeals, Snipes served 3 years in federal prison at McKean Federal Correctional Institution in Pennsylvania. His case demonstrated the court's consistent rejection of fringe, constitutional theories about taxation and served as a high-profile warning to other celebrities considering similar tax avoidance schemes. 7. Grammy-winning artist Lauryn Hill's tax problems stemmed from her self-imposed exile from the music industry. At the height of her fame after The Miseducation of Lauryn Hill won 5 Grammy Awards, she withdrew from public life, citing the need to protect herself and her family from the superficial vagaries of the industry. During this period from 2005 to 2007, while still earning substantial royalties and performance fees, totaling approximately $2.3 million, Hill failed to file tax returns or pay taxes. When charged by federal authorities, she offered a unique defense, claiming she had gone underground to protect herself and her family, intentionally removing herself from society, including its tax obligations. The judge was unpersuaded by this reasoning. In 2013, Hill was sentenced to 3 months in federal prison, followed by 3 months of home confinement, and ordered to pay over $970,000 in back taxes and penalties. 8. Martha Stewart's legal issues weren't limited to her insider trading conviction. The lifestyle guru found herself in hot water with New York State tax authorities over her East Hampton vacation home. Stewart claimed she didn't spend enough time at the residence to qualify as a New York resident for tax purposes, attempting to avoid state income taxes in 1991 and 1992. However, investigators discovered her frequent use of the property by tracking her American Express charges, phone records, and even her appearances in her own magazine, which frequently featured the East Hampton home. Stewart initially fought the assessment but ultimately settled, paying $20,000 in unpaid taxes, interest, and penalties. Her case highlighted the aggressive tactics states employ to collect taxes from wealthy residents who maintain homes in multiple tax jurisdictions, particularly those attempting to claim residence in states with no income tax while maintaining their actual lifestyle in high-tax states. 9. Baseball's all-time hits. Leader Pete Rose couldn't hit his way out of tax trouble. In 1990, after being banned from baseball for gambling, Rose faced federal tax evasion charges for failing to report more than $350,000 in income derived from autograph signings, memorabilia, sales, and gambling winnings. The IRS investigation revealed Rose had arranged for appearance fees to be paid directly to associates, or in cash, to avoid creating a paper trail. He also bartered signed memorabilia for services and goods without reporting the value as income. Pleading guilty to 2 felony counts of filing false tax returns, Rose was sentenced to 5 months in prison at the Federal Correctional Facility in Marion, Illinois, fined $50,000, and ordered to perform 1,000 hours of community service. His tax problems continued long after his initial conviction, with the IRS filing a $1 million lien against him in 2004 for unpaid taxes, penalties, and interest. 10. Nicolas Cage's tax saga reads like the plot of a Hollywood thriller, complete with villainous financial advisors and the dramatic sale of priceless treasures. The Oscar-winning actor accumulated more than $14 million in tax debt, including $6.7 million from 2008 alone. His financial downfall stemmed from a combination of extravagant spending, including 2 castles, a private island, dinosaur skulls, and dozens of rare cars, and alleged mismanagement by his business manager, Samuel Levin. Cage sued Levin for $20 million, claiming fraud and negligence, while Levin countersued, arguing that he had warned Cage about his unsustainable spending. To satisfy his enormous tax bill, Cage was forced to sell many of his prized possessions, including a rare Action Comics #1 that contained Superman's first appearance, which fetched over $2 million at auction. After a decade of financial restructuring, Cage announced in 2022 that he had finally satisfied all tax obligations. 11. Willie Nelson's tax troubles represent perhaps the most creative resolution in IRS history. In 1990, the IRS hit the country music legend with a staggering $16.7 million tax bill, one of the largest individual assessments at that time. Nelson had invested in a tax shelter that was subsequently disallowed by the IRS, leaving him with massive back taxes, penalties, and interest. When agents raided his home, they seized nearly everything except his iconic guitar Trigger. Faced with financial ruin, Nelson worked out an unprecedented arrangement with the IRS. He would record a special album titled The IRS Tapes, Who'll Buy My Memories, with proceeds going directly to the government. Nelson also sued his former accounting firm, Price Waterhouse, for negligent tax advice, using the settlement to help resolve his remaining tax debt. After years of payment plans and negotiations, Nelson eventually settled his obligations for approximately $6 million, turning a potential career-ending disaster into another chapter in his outlaw country mythology. 12. Richard Hatch, the first winner of the reality TV show Survivor, learned that while he could outwit, outplay, and outlast his competitors on a deserted island, he couldn't evade the IRS. After publicly receiving his $1 million prize on national television in 2000, Hatch failed to report this income or pay taxes on it, despite CBS issuing him a Form 1099 and withholding some taxes at the time of payment. During his 2006 trial, Hatch offered an unusual defense, claiming that producers had promised to pay his taxes in exchange for his silence about alleged cheating during the show's filming. No evidence supported this claim, and the jury quickly convicted him. Sentenced to 51 months in federal prison, Hatch served his time, but continued to have tax problems, returning to prison for an additional 9 months when he failed to amend his returns as ordered by the court. His case became a textbook example of how public winnings create inescapable tax liabilities. 13. Girls Gone Wild. Creator Joe Francis discovered that the IRS doesn't take kindly to creative accounting. In 2007, the controversial entrepreneur faced charges for filing false business tax returns that claimed more than $20 million in fictitious business expenses. The investigation revealed Francis had used corporate accounts to pay for personal extravagances, including a $10 million Mexican villa, private jet travel, and luxury cars, while deducting them as business expenses. When his tax problems began, Francis attempted to hide assets and obstruct the investigation, leading to additional charges. He eventually pleaded guilty to filing false tax returns and bribery, admitting he had attempted to give $500,000 worth of goods to jail workers for preferential treatment during a previous incarceration. This hybrid of comedy and commentary on American celebrity culture showcased how flimsy the line between personal and business expenses can become when entrepreneurs achieve rapid success without proper financial controls. 14. Heidi Fleiss, the notorious Hollywood madam, learned that illegal businesses still generate taxable income. In 1996, following her conviction on state pandering charges for running a high-end prostitution ring catering to Hollywood elites, Fleiss faced federal charges for tax evasion and money laundering. Prosecutors demonstrated that while operating her illicit enterprise, which reportedly generated millions annually, Fleiss failed to file tax returns or pay taxes on her substantial income. The investigation revealed elaborate measures to conceal her earnings, including using cash-only transactions, maintaining false identities, and funneling money through various shell entities. Though her defense argued that requiring her to report income from illegal activities violated her Fifth Amendment protection against self-incrimination, the courts rejected this argument, reaffirming the principle that all income, regardless of source, is taxable. Sentenced to 37 months in federal prison, Fleiss's case highlighted the government's two-pronged approach to criminal enterprises, prosecuting both the underlying illegal activity and the related tax crimes. 15. Mafia boss John Gotti, known as the Teflon Don, for repeatedly evading conviction on murder and racketeering charges, finally met his match in the IRS. After 3 high-profile acquittals earned him his nickname, federal prosecutors built a case combining wiretap evidence, testimony from underboss Sammy the Bull Gravano, and meticulous financial analysis showing Gotti's luxurious lifestyle, including $10,000 suits and lavish celebrations, with no reported income. The 1992 trial focused not only on organized crime activities but also on Gotti's complete failure to file tax returns, despite controlling millions in criminal proceeds and legitimate businesses in New York. Convicted on all charges, including tax evasion, Gotti received a life sentence without parole and died in prison in 2002. His case reinforced a strategy dating back to Al Capone. When conventional criminal charges prove difficult to prosecute, tax charges can provide a more straightforward path to conviction for organized crime figures. 16. Italian film icon Sophia Loren's tax case became an international incident when she served 18 days in a Naples women's prison in 1982 for tax evasion. The charges stemmed from her 1974 tax return, which prosecutors claimed underreported her income by approximately 10 billion lire, about $7.5 million. Lauren had been living primarily in France and Switzerland, claiming tax residency outside Italy, but Italian authorities determined she maintained sufficient economic ties to Italy to create tax liability there. After exhausting her appeals, the actress returned to Italy to serve her sentence, generating global headlines as one of the few international celebrities to actually serve prison time for tax crimes. The case demonstrated that even at the height of fame, tax authorities could reach across borders to enforce compliance. Decades later, in 2013, the Italian Supreme Court would finally vindicate Loren, ruling that her 1974 tax calculations had been correct all along, concluding one of the longest-running tax disputes involving a major celebrity. 17. In perhaps the most ironic tax evasion case in history, former IRS Commissioner Joseph Noonan was convicted of the very crime he had once prosecuted. Noonan, who led the IRS from 1944 to 1947, failed to report significant income on his 1949 tax return, including more $800 won from a bet that President Harry Truman would win re-election in 1948. The investigation uncovered that Noonan had purchased a $90,000 Manhattan apartment and a $40,000 Florida home while reporting modest income. Additionally, he had bought a Cadillac with cash and made numerous large cash transactions that couldn't be explained by his reported income. The jury took just 4 hours to convict him in 1954. Sentenced to 5 years in prison and fined $15,000, Noonan's case served as a stark reminder that even those who once enforced tax laws were not above them, cementing the principle that the tax system applies equally to everyone, even its former administrators. 18. Enron Corporation's 2001 collapse represented more than just corporate bankruptcy. It exposed one of the most elaborate financial frauds in American history. The Houston-based energy trading company had used a complex web of special-purpose entities, mark-to-market accounting, and offshore vehicles to hide billions in debt and inflate profits. CEO Kenneth Lay, COO Jeffrey Skilling, and CFO Andrew Fastow orchestrated schemes that transformed ordinary business losses into paper profits through entities with names like Chuco and Raptor. When the house of cards finally collapsed, Enron's stock plummeted from $90 to pennies, destroying $74 billion in shareholder value and $2 billion in employee pension funds. The subsequent criminal trials resulted in multiple convictions. Skilling received 24 years, later reduced, while Fastow cooperated with prosecutors and served 5 years. Lay died before sentencing. Beyond the human toll, Enron's implosion directly led to the Sarbanes-Oxley Act, fundamentally changing corporate governance and accounting oversight in America. 19. WorldCom's $11 billion accounting fraud sent shockwaves through financial markets when discovered in 2002, creating what was then the largest bankruptcy in American history. Under CEO Bernie Ebbers' leadership, the telecommunications giant systematically reclassified operating expenses as capital expenditures, essentially treating everyday costs like investments that could be depreciated over years rather than recognized immediately. This deception massively inflated profits during the telecom boom's decline. When internal auditor Cynthia Cooper discovered the irregularities and alerted the board, the company was forced to restate its financials, revealing the true scale of the fraud. Ebbers, who had borrowed hundreds of millions from WorldCom to cover personal margin calls on company stock, was convicted of fraud, conspiracy, and filing false reports. Sentenced to 25 years, he served 13 before receiving compassionate release in 2019, dying shortly thereafter. WorldCom's collapse destroyed 17,000 jobs and billions in investor value while further eroding public trust in corporate America's financial reporting. 20. Arthur Andersen. LLP's destruction marked the unprecedented collapse of a Big Five accounting firm due to criminal conviction. Founded in 1913, the firm had built a reputation for integrity with its motto, "Think straight, talk straight." That legacy ended when Andersen served as Enron's auditor while simultaneously earning millions in consulting fees from the energy company, a clear conflict of interest. As Enron unraveled and federal investigations began, Andersen employees destroyed tons of documents related to their Enron work. This systematic shredding led to the firm's 2002 conviction for obstruction of justice. Though the Supreme Court later overturned the verdict on technical grounds, the damage was irreversible. Clients had already fled, and the firm surrendered its licenses to practice. From 85,000 employees worldwide, Andersen essentially ceased to exist. The firm's implosion led directly to the prohibition of certain consulting services by auditors under the Sarbanes-Oxley Act, forever changing the accounting profession's regulatory landscape. 21. KPMG's tax shelter scandal demonstrated how aggressively some accounting firms marketed questionable tax avoidance schemes to wealthy clients. Between 1996 and 2003, the accounting giant created and marketed 4 complex tax shelters with acronyms BLIPS, FLIPS, OPUS, and SOS, generating $11 billion in artificial tax losses that helped clients avoid approximately $2.5 billion in legitimate taxes. These elaborate schemes involved creating paper entities that appeared to have economic substance but existed solely to generate tax losses. When IRS investigations intensified, KPMG initially defended the shelters as legitimate tax planning before ultimately admitting wrongdoing. In 2005, the firm reached a $456 million deferred prosecution agreement to avoid criminal indictment, which would have been a death sentence for the firm after the Arthur Andersen collapse. 9 individuals, including former KPMG partners and tax attorneys, faced criminal charges. The case fundamentally changed how accounting firms approach tax services, with the IRS implementing a tax shelter registration system and firms establishing stricter internal controls. 22. UBS's 2009 tax evasion settlement cracked the centuries-old Swiss banking secrecy system, forever changing how wealthy Americans hide assets offshore. For decades, the Swiss banking giant had actively helped U.S. clients conceal approximately $20 billion in assets, using coded language, numbered accounts, and shell companies to evade U.S. tax authorities. The scheme unraveled when banker Bradley Birkenfeld became a whistleblower, revealing that UBS bankers would travel to American art shows and yacht regattas to meet clients, sometimes smuggling diamonds in toothpaste tubes to help clients move assets undetected. Facing criminal prosecution, UBS agreed to pay a $780 million fine and, more significantly, provided information on 4,450 American account holders to the IRS, an unprecedented breach of Swiss banking secrecy. This case directly led to the Foreign Account Tax Compliance Act, FATCA, requiring foreign financial institutions to report accounts held by U.S. taxpayers or face severe penalties, fundamentally altering global banking practices. 23. Credit Suisse's tax evasion scandal spanned decades, evolving from a 2014 guilty plea to continued violations discovered after UBS acquired the troubled bank in 2023. Initially, Credit Suisse admitted to helping wealthy Americans hide over $4 billion across at least 475 undeclared accounts, using techniques including creating shell companies, encouraging clients to withdraw funds as jewels or cash, and maintaining a special desk in Zurich Airport to assist clients moving undeclared assets. The bank paid $2.6 billion in 2014 for these violations. Yet investigators discovered Credit Suisse continued helping clients evade U.S. taxes even after the plea agreement, maintaining legacy hidden accounts. This hybrid of comedy and commentary on banking ethics reached its conclusion in 2025 when UBS, having acquired Credit Suisse's assets, paid an additional $511 million to settle these continuing violations. The decade-spanning case highlighted the extraordinary persistence of tax evasion cultures within certain financial institutions, even in the face of significant legal consequences. 24. The Panama Papers represented the largest data leak in history, exposing 11.5 million documents from Panamanian law firm Mossack Fonseca in 2016. The leaked records revealed how the firm helped clients establish over 214,000 offshore entities used to hide assets, evade taxes, and circumvent sanctions. The documents implicated 12 current or former world leaders, 128 public officials, and countless wealthy individuals worldwide. Prominent names included associates of Russian President Vladimir Putin, then British Prime Minister David Cameron's father, and Iceland's Prime Minister Sigmundur David Gunnlaugsson, who resigned following the revelations. Beyond individual consequences, the leak fundamentally altered international tax enforcement, accelerating global agreements on financial transparency and automatic information exchange. The coordinated investigation by the International Consortium of Investigative Journalists led to over $1.3 billion in recovered taxes and penalties worldwide. The scandal illustrated both the scale of offshore tax evasion and how quickly digital leaks could dismantle previously impenetrable secrecy systems. 25. Colombian pop star Shakira's Spanish tax case hinged on a critical question. Where did she actually live from 2012 to 2014? While the singer claimed she maintained residency in the Bahamas, a tax haven, during those years, Spanish prosecutors built a case that she had spent more than 183 days annually in Spain, the threshold for tax residency. Investigators tracked her movements through social media posts, shopping receipts, salon appointments, and even her frequent visits to her Barcelona-based doctor during pregnancy. The evidence overwhelmingly showed she had been living in Spain with FC Barcelona player Gerard Piqué while failing to pay $14.5 million in taxes. After initially fighting the charges and rejecting settlement offers, Shakira ultimately pleaded guilty in November 2023 to 6 counts of tax fraud. She received a 3-year suspended prison sentence and paid a $7.3 million fine on top of the $17.2 million in taxes and interest she had already repaid, resolving one of the highest-profile celebrity tax cases in recent European history. 26. Lionel Messi's tax fraud conviction came as a shock to football fans worldwide. The Argentinian soccer superstar and his father Jorge were convicted by Spanish authorities in 2017 for using a sophisticated network of shell companies in Belize, Switzerland, Uruguay, and the United Kingdom to hide earnings from image rights between 2007 and 2009. Despite Messi's claims that he merely signed documents without reading them, the court determined he had knowingly defrauded Spain of 4.1 million. Initially sentenced to 21 months in prison, the sentence was later reduced to a $252,000 fine, as Spanish law typically suspends prison terms under 2 years for first-time offenders of non-violent crimes. The Spanish Supreme Court upheld the conviction, reinforcing that even beloved sports icons couldn't claim ignorance of their financial affairs. The case prompted numerous other football stars to proactively settle their own tax issues, including Messi's rival Cristiano Ronaldo, demonstrating the ripple effect that high-profile tax prosecutions can have across an industry. 27. Cristiano Ronaldo's Spanish tax case paralleled Messi's, focusing on the Portuguese superstar's use of offshore structures to hide income from image rights contracts. Between 2011 and 2014, while playing for Real Madrid, Ronaldo channeled approximately $150 million in endorsement earnings through a company in the British Virgin Islands, effectively shielding this income from Spanish taxation. Spanish prosecutors built their case by tracing money flows through multiple jurisdictions and comparing Ronaldo's actual endorsement contracts with what he reported to tax authorities. After initially proclaiming his innocence, "I always pay what I have to pay. I'm a clean person, a clean man," Ronaldo eventually agreed to plead guilty to 4 counts of tax fraud in 2018. He accepted a suspended 23-month prison sentence and agreed to pay $18.8 million in back taxes, fines, and interest. His case, alongside Messi's, prompted Spanish tax authorities to scrutinize other high-profile athletes and entertainers, recovering hundreds of millions in previously unpaid taxes. 28. Reality TV stars. Teresa and Joe Giudice of The Real Housewives of New Jersey learned that flaunting wealth on television attracts not just viewers but also IRS attention. In 2013, the couple was indicted on 39 counts of fraud and tax charges, including conspiracy to commit mail fraud, wire fraud, bankruptcy fraud, and failure to file tax returns. Joe had completely failed to file returns from 2004 to 2008, despite earning approximately $1 million during that period. The investigation revealed they had submitted fraudulent loan applications, hiding assets and income during bankruptcy proceedings, and created fake W-2 forms and tax returns to secure millions in loans. Their conspicuous consumption on television, including a memorable $120,000 cash furniture buying spree, contrasted sharply with their financial declarations to courts and creditors. Both pleaded guilty in 2014, with Teresa sentenced to 15 months in prison and Joe to 41 months, followed by deportation to his native Italy since he never became a U.S. citizen despite living in America since childhood. 29. The DC Solar case represents one of the largest Ponzi schemes in American history, disguised as a green energy investment. Founders Jeff and Paulette Karpoff built what appeared to be a legitimate business selling mobile solar generators to investors who could claim valuable renewable energy tax credits. In reality, they manufactured only a fraction of the 17,000 units they claimed to have built, creating fake serial numbers and documentation for non-existent generators. The scheme attracted approximately $1 billion from investors, including Warren Buffett's Berkshire Hathaway, which lost $340 million. The Karpoffs used the money to fund an astonishingly lavish lifestyle, including 150 luxury vehicles, a professional baseball team, a NASCAR sponsorship, luxury real estate, and a $500,000 holiday party featuring the band Pitbull. When the fraud collapsed in 2018, investors not only lost their investments but also faced IRS demands to repay the fraudulently claimed tax credits with penalties and interest. Jeff Karpoff received 30 years in prison and was ordered to pay $790.6 million in restitution, while Paulette received 11 years. 30. Reality TV personalities. Todd and Julie Chrisley, stars of Chrisley Knows Best, discovered that projecting an image of wealth on television creates an indelible record that tax authorities can use against you. The couple, known for their lavish lifestyle and outrageous Southern family dynamics, were convicted in 2022 of conspiracy to defraud the IRS, tax evasion, and bank fraud. Prosecutors demonstrated that the Chrysleys had evaded taxes since 2009 by routing income from their reality show and other businesses through a loan-out company called Seven Seas Productions, then transferring money to personal accounts while keeping formal ownership in relatives' names. This allowed them to hide income and evade collection on approximately $500,000 in delinquent taxes. Bank fraud charges stemmed from submitting false financial statements to obtain over $30 million in loans. Following their conviction, Todd was sentenced to 12 years in federal prison and Julie to 7 years, effectively ending their reality television careers and transforming their public narrative from aspirational wealth to cautionary tale. 31. Defense contractor Douglas Edelman's $350 million tax evasion case exemplifies how military supply chains created opportunities for massive fraud. Through his company, Mina Corp., Edelman secured $7 billion in jet fuel supply contracts for U.S. military operations in Kyrgyzstan and Afghanistan. While the contracts were legitimate, Edelman allegedly diverted vast profits to undeclared offshore accounts at Credit Suisse, UBS, and other Swiss banks. The 2024 indictment revealed that Credit Suisse employees were aware since 2008 that Edelman's accounts weren't disclosed to the IRS, but continued helping him structure his holdings to avoid detection. The case gained political dimensions when a Senate Finance Committee investigation discovered Edelman had maintained these hidden accounts for years while receiving billions in taxpayer-funded contracts. The prosecution highlighted the contradiction of an individual profiting enormously from government contracts while systematically defrauding the same government of tax revenue, raising questions about contractor vetting processes for military procurement. 32. The Swiss banking investigations between 2021 and 2025 revealed that despite landmark settlements with UBS and Credit Suisse, the practice of helping Americans hide assets continued across Switzerland's banking sector. As larger banks came under scrutiny, they allegedly transferred problematic American accounts to smaller institutions, including PKB Private Bank, Julius Baer, and Union Bancaire Privée, essentially playing a shell game with undeclared assets. Senate Finance Committee investigations uncovered evidence that bankers used coded language in internal communications, referring to American clients as non-U.S. in official documentation while maintaining separate records of their true nationality. This hybrid of comedy and commentary on regulatory whack-a-mole showed how difficult it was to fundamentally change banking cultures built around secrecy. The investigations led to additional settlements totaling over $1.2 billion and demonstrated that Swiss banking secrecy, while legally diminished, continued as an operational practice through increasingly sophisticated methods, prompting renewed enforcement efforts and stronger international banking regulations. 33. Germany's Cum-Ex and Ex-Cum trading scandal represents perhaps the largest tax fraud in European history, costing German taxpayers at least $31.8 billion. The scheme exploited a loophole in German dividend tax law, allowing multiple parties to claim refunds for the same tax that was paid only once. In these transactions, shares were rapidly traded around dividend dates, creating confusion about ownership and enabling multiple refund claims for a single tax payment. The complexity was intentional. Banks, lawyers, and wealthy investors coordinated to execute transactions so convoluted that tax authorities couldn't track actual ownership. When investigators finally unraveled the scheme in 2017, they discovered involvement from major financial institutions, including Deutsche Bank, Barclays, and Macquarie Group. 6 investment bankers and lawyers faced criminal charges for their roles in what prosecutors called organized crime in suits. The scandal prompted Germany to close the tax loophole and pursue aggressive recovery efforts, with numerous financial institutions paying settlements while continuing to face civil and criminal proceedings. 34. Big Tech's tax avoidance strategies became an international flashpoint between 2016 and 2020, highlighting how digital business models created unprecedented opportunities to shift profits to low-tax jurisdictions. Companies including Google, Apple, and Amazon utilized complex structures with names like the Double Irish, and Dutch sandwich to legally route billions in profits through subsidiaries in Ireland, the Netherlands, and ultimately tax havens like Bermuda. Apple's arrangement with Ireland drew particular scrutiny, with the European Commission ordering the company to pay 13 billion, 15.4 billion in back taxes after determining its effective tax rate had dropped as low as 0.05% in 2014. While the companies maintained their structures were legal under international tax law, public outrage over the minimal taxes paid by highly profitable tech giants led to fundamental changes. The OECD developed a new framework for international taxation of digital services, and many countries unilaterally implemented digital services taxes. These cases demonstrated how traditional tax systems struggled to address the realities of the digital economy. 35. Rapper Ja Rule, Jeffrey Atkins, learned that the IRS has a remarkable memory. His first tax conviction came in 2011 for failing to file tax returns from 2004-2008 on more than $3 million in income, resulting in 2 years of imprisonment and a $1.1 million tax bill. One might think this experience would ensure future compliance, but in 2021, Atkins faced additional IRS suits for failing to pay taxes from 2012-2017. This pattern made him one of the few celebrities with multiple tax convictions separated by years. During his sentencing hearing, the judge noted the irony that someone smart enough to build an entertainment career seemed incapable of meeting basic tax obligations. Atkins blamed his youth and poor financial management, telling the court, "I was a young man who made a lot of money at a very young age." His case illustrates the IRS's long institutional memory and willingness to pursue repeat offenders, particularly those who return to non-compliance after previous enforcement actions. 36. Fat Joe, Joseph Cartagena, found himself in tax trouble despite his hit song, Make It Rain. The Grammy-nominated rapper failed to file tax returns from 2007-2010 while earning over $3.3 million from music royalties, Terror Squad productions, and various endorsements. His case highlighted a common pattern among entertainment figures who experience sudden financial success without establishing proper tax compliance systems. When sentenced to 4 months in federal prison in 2013, Cartagena told the court, "I did everything I possibly can to ensure that this doesn't happen again." The judge acknowledged his charitable work in the community, but emphasized the importance of setting an example, noting that there are millions of Americans who pay their taxes on far less income. Beyond the prison term, Cartagena paid the full $718,038 in back taxes, plus penalties and an additional $15,000 fine. His case demonstrated that even brief periods of non-compliance can result in criminal prosecution when the amounts involved are substantial. 37. Lil Wayne's tax troubles accumulated over decades, with liens against the rapper totaling more than $12 million. Unlike cases involving deliberate evasion schemes, Wayne's tax issues stemmed primarily from poor financial management during his meteoric rise from teenage phenom to hip-hop superstar. Beginning around 2002, when he was just 20 years old, Wayne began accumulating tax debt that would follow him for the next 17 years. The IRS filed liens of $1.13 million in 2010, $5.6 million in 2011, and a staggering $12 million by 2014. While Wayne avoided criminal charges, the liens threatened his assets, including his Miami Beach mansion and extensive car collection. The case illustrated how quickly tax debt compounds with penalties and interest, turning manageable amounts into potentially career-ending obligations. After years of working with tax professionals and restructuring his business affairs, Wayne finally settled all outstanding tax debt in 2019, later referencing the ordeal in lyrics as a cautionary tale about wealth management. 38. Hip-hop artist Nelly, Cornell Haynes Jr., faced a $2.4 million IRS tax lien in 2016 for unpaid taxes from 2013. The hot and airy performer's financial crisis became public when the IRS threatened to seize his property, including his Missouri mansion. What made Nelly's case notable was the public response. Fans organized a streaming campaign of his music to help generate royalties, with the hashtag #YusherSaveNelly trending as supporters played his songs on repeat. While this unconventional approach generated publicity, It produced minimal financial impact compared to the size of his tax debt. Nelly eventually reached a settlement with the IRS after selling properties and restructuring his business affairs. His case highlighted common issues facing entertainers: irregular income patterns, reliance on financial managers who may lack tax expertise, and the challenge of maintaining consistent tax compliance across multiple income streams including music royalties, touring, endorsements, and business ventures, all while being creative professionals rather than financial experts. 39. Actress Lindsay Lohan discovered the IRS doesn't care about celebrity status when they seized her bank accounts in 2012 to cover $230,000 in unpaid taxes for 2009 and 2010. The action came after multiple warnings and failed payment arrangements, forcing the actress to address her tax issues at a time when she was already facing numerous legal troubles related to substance abuse and probation violations. Reports indicated that Lohan was caught completely by surprise by the account seizures, illustrating how even publicly known tax debts are sometimes ignored by celebrities until enforcement actions directly impact their daily lives. Lohan reportedly received financial assistance from Charlie Sheen, who gave her $100,000 to help address the tax debt. The case served as a public reminder of the IRS's broad collection powers, including the ability to take funds directly from bank accounts after proper notification, regardless of the taxpayer's public profile or other ongoing legal challenges. 40. Former Tyco CEO Dennis Kozlowski's tax case stemmed from his extravagant personal expenditures disguised as corporate expenses. While the broader case involved looting his company through unauthorized bonuses and fraudulent stock sales, his tax evasion charge focused specifically on avoiding New York sales tax on fine art. Kozlowski purchased 12 paintings from masters, including Claude Monet and Pierre-Auguste Renoir, for his Manhattan apartment, but had empty boxes shipped to Tyco offices in New Hampshire, which has no sales tax, before privately redirecting the actual artwork to his New York residence. This scheme allowed him to evade approximately $1 million in New York state and city sales taxes. During the investigation, prosecutors discovered Kozlowski's infamous $6,000 shower curtain and $15,000 dog umbrella stand, which became symbols of his excess. Convicted in 2005 of grand larceny, conspiracy, and tax fraud, Kozlowski was sentenced to 3 to 25 years in prison. His case highlighted how corporate fraud and personal tax evasion often intertwine when executives blur the line between corporate and personal resources. 41. Tom Daschle's tax issues derailed his 2009 nomination for Secretary of Health and Human Services under President Obama. The former Senate Democratic leader failed to report and pay taxes on a car and driver provided by a private equity firm where he worked as an advisor after leaving Congress. Although seemingly a minor oversight compared to other tax cases, the timing proved devastating. Daschle's nomination came during the financial crisis when public anger toward wealthy individuals perceived as not paying their fair share was at its peak. When the vetting process revealed he had failed to report the car service as income and owed approximately $128,000 in back taxes and interest, the political damage was irreparable. Despite having already paid the taxes and penalties before his nomination hearings, Daschle withdrew his name from consideration, acknowledging that his tax issues would be a distraction. His case demonstrated how even relatively modest tax compliance failures can have outsized consequences for public figures, particularly those seeking positions requiring Senate confirmation. 42. Congressman Charles Rangel's tax troubles were especially problematic given his position as chairman of the House Ways and Means Committee, the very committee responsible for writing tax laws. In 2010, following a 2-year ethics investigation, Rangel was found guilty of 11 ethics violations, including failure to report rental income from his Dominican Republic vacation villa on his tax returns for 17 years. The investigation also revealed he had failed to report hundreds of thousands of dollars in assets on his financial disclosure forms and had improperly used a rent-stabilized apartment as a campaign office. Despite a passionate plea for fairness and mercy from his colleagues, the House of Representatives voted 333 to 79 to censure him, the most severe punishment short of expulsion. Rangel, who had previously worked as a tax attorney, claimed these were unintentional oversights rather than deliberate evasion. Nevertheless, his case became a powerful example of the principle that those who write tax laws must be beyond reproach in their own tax compliance. 43. Timothy Geithner's confirmation as Treasury Secretary in 2009 nearly collapsed over his failure to pay Social Security and Medicare taxes while working at the International Monetary Fund. As an international organization, the IMF doesn't withhold these taxes for U.S. employees, but instead provides additional compensation for them to pay these taxes themselves, a system Geithner failed to navigate properly from 2001 to 2004. When the issue surfaced during his vetting, Geithner paid $34,023 in back taxes and $8,670 in interest. What made the case particularly problematic was that as Treasury Secretary, Geithner would oversee the IRS. During confirmation hearings, senators questioned how someone with his financial expertise could make such an error, with some suggesting it reflected either incompetence or willful avoidance. Despite the controversy, Geithner was confirmed by a 60-34 vote and served throughout Obama's first term. His case demonstrated the heightened scrutiny applied to tax issues for officials responsible for financial policy and the occasional willingness of the Senate to overlook tax problems for nominees deemed essential to addressing national priorities. In this case, the ongoing financial crisis. 44. Lobbyist Jack Abramoff's tax evasion was just one component of a corruption scandal that reshaped Washington lobbying rules. At the height of his influence, Abramoff commanded millions in fees from clients including Native American tribes with casino interests. His tax evasion scheme involved creating a fraudulent wire transfer to make it appear he had borrowed money to purchase Sun Cruise casinos, when in fact he was using undeclared income. He also failed to report millions in income diverted to entities he secretly controlled. When his broader corruption schemes unraveled, Abramoff pleaded guilty in 2006 to 3 felony counts, including tax evasion, fraud, and conspiracy to bribe public officials. He served 43 months of a 6-year sentence before release to a halfway house. The scandal's breadth was extraordinary, ultimately implicating numerous congressional staffers, Bush administration officials, and affecting lobbying regulations across Washington. His case became the basis for the 2010 film Casino Jack and represented one of the most significant corruption prosecutions in modern Washington history. 45. O.J. Simpson's tax troubles persisted long after his infamous murder trial and subsequent civil judgment. In 2011, the former NFL star appeared on California's list of biggest tax offenders, owing the state $144 million. Simultaneously, he faced a federal tax lien for $17,015.99. These tax problems continued despite the $33.5 million civil judgment against him in the wrongful death case brought by the Goldman and Brown families. Simpson's ongoing tax delinquency highlighted the challenges tax authorities face when collecting from individuals with complex financial situations involving judgments, asset protection trusts, and retirement accounts with different levels of protection from creditors. While serving a prison sentence in Nevada for an unrelated armed robbery conviction, Simpson's NFL pension of approximately $25,000 monthly continued to be protected from most creditors under federal ERISA laws, but remained subject to certain tax levies. His case illustrated how individuals with significant public judgments often face overlapping collection efforts from multiple creditors, including tax authorities, with different legal priorities and collection powers. 46. NFL Hall of Fame player Ron Mix's tax case demonstrated that even respected professionals can make disastrous financial decisions. After his successful football career with the San Diego Chargers, Mix became a prominent workers' compensation attorney, specializing in representing fellow athletes. Between 2010 and 2013, he paid approximately $155,000 in referral fees to a non-attorney for client referrals, a common practice in the legal profession. However, Mix crossed into criminal territory when he reported these payments as charitable contributions on his tax returns, converting ordinary business expenses into fraudulent charitable deductions. The scheme unraveled during a broader investigation into college basketball corruption, revealing that the referral fees went to former NBA player Kermit Washington, who falsely portrayed his charity as helping needy children in Africa while using most donations for personal expenses. Mix pleaded guilty to filing a false tax return and paid a fine of nearly $50,000. This analytical reflection with closing wit reminds us that even decorated professionals can find themselves on the wrong side of tax law when tempted by seemingly minor shortcuts. 47. Olympic gold medalist Lindsey Vonn faced a $1.7 million IRS tax lien in 2012, highlighting the complex financial challenges facing professional athletes. The skiing champion's tax troubles emerged at the height of her career, threatening her financial stability despite her success on the slopes and lucrative endorsement deals with companies including Red Bull, Rolex, and Under Armour. Unlike many tax delinquency cases that progress to criminal charges, Vonn immediately addressed the situation, paying the full liability within days of the lien being filed. She publicly attributed the tax issues to mismanagement by another person handling her finances, a common thread in celebrity tax cases. What made Vonn's case notable was her immediate response and transparency. Rather than fighting the assessment or negotiating a payment plan, she promptly resolved the entire debt, demonstrating both the financial resources available to successful athletes and the importance of quickly addressing tax problems before they escalate into criminal investigations or reputational damage that could threaten endorsement relationships. 48. R&B singer Toni Braxton's tax troubles spanned decades and intertwined with her two bankruptcy filings. In 2010, the IRS filed a $396,000 lien against the six-time Grammy winner. After paying that debt, reports emerged that she owed an additional $780,000 in state and federal taxes by 2018. Braxton's financial struggles were particularly notable because they persisted despite her successful music career with hits, including Unbreak My Heart and Breathe Again, which sold over 67 million records worldwide. Her case highlighted how entertainment industry success doesn't necessarily translate to financial stability, especially when artists face health challenges. Braxton has been open about her battles with lupus and the related medical expenses. The repeated tax and financial issues also demonstrated how difficult it can be for celebrities to rebuild financial stability once they fall into a cycle of tax delinquency, bankruptcy, and financial mismanagement, even with continued income from royalties and performances. 49. Comedy legends. Abbott and Costello discovered that laughter doesn't exempt you from tax obligations. During the 1940s and early 1950s, the duo ranked among the highest-paid entertainers in America, earning millions from their films, radio shows, and live performances. However, they failed to properly withhold taxes from their substantial earnings over multiple years. When the IRS finally caught up with them, the accumulated back taxes, penalties, and interest were so enormous that both men were forced into bankruptcy despite their immense popularity. The financial devastation contributed to the dissolution of their partnership in 1957. Their case exemplified the particular vulnerability of entertainment partnerships to tax problems, as neither partner typically handles financial matters directly, instead relying on agents, managers, and accountants who may prioritize booking more lucrative deals over ensuring proper tax compliance. This analytical reflection with closing wit reminds us that even those who made millions laugh couldn't make the tax collector smile. 50. Swiss banker Renzo Godola's case demonstrated how quickly the impenetrable wall of Swiss banking secrecy could crumble when faced with personal criminal liability. As a former UBS private banker who later established his own financial advisory firm, Godola had spent years helping wealthy Americans hide assets in Swiss accounts. His world collapsed in 2010 when he was arrested in a Miami hotel room during a meeting with a client who was cooperating with U.S. authorities. Facing significant prison time, Godola made an extraordinary decision. He became one of the first Swiss financial professionals to cooperate fully with American investigators, providing detailed information about how Swiss banks facilitated tax evasion. His cooperation helped authorities identify numerous American tax evaders and led to the prosecution of two other Swiss bankers. In recognition of this unprecedented assistance, Godola received probation rather than prison time. His case represented a pivotal moment in the U.S. government's campaign against offshore tax evasion, demonstrating that the loyalty of foreign bankers to their clients had limits when their own freedom was at stake. 51. Tax protester Vernice Kuglin achieved something extraordinarily rare. She won a federal tax evasion case against the IRS. The 58-year-old FedEx pilot had not filed tax returns or paid taxes for 6 years, accumulating over $1 million in unreported income. Unlike typical tax evaders who hide income, Kuglin openly challenged the legal basis for income taxation. She sent numerous letters to the IRS requesting specific citations of laws requiring her to pay income tax. When the agency didn't respond substantively to her satisfaction, she stopped filing returns. Prosecutors expected an easy conviction, as courts have consistently rejected tax protest arguments. Yet in 2003, a Memphis jury acquitted Kuglin of all criminal charges after accepting her defense that she genuinely believed she was seeking legitimate answers about her tax obligations rather than willfully evading taxes. While the verdict didn't legitimize her legal theories, she still owed the taxes civilly. It highlighted the critical importance of the willfulness element in criminal tax cases and the power of juries to occasionally deliver surprising verdicts, even in seemingly straightforward prosecutions. So that wraps up our journey through the biggest tax evasion cases ever exposed. From Al Capone's downfall to the Panama Papers and Swiss banking scandals, these cases prove that financial crime knows no boundaries of wealth, fame, or power. But what do you think? Are these cases evidence of a fundamentally broken system, or proof that justice eventually catches up to everyone? Perhaps Robert Brockman's $2 billion scheme or UBS's $780 million settlement changed your perspective on who really pays their fair share. Did we miss any shocking tax evasion stories that deserve recognition? Share your thoughts in the comments. The most insightful ones get pinned. If you appreciated this deep dive into financial crime, prove it. Hit subscribe for our upcoming investigation into white-collar corruption networks.